especially if you're a beginner trying to navigate the financial markets. Let me ask you something. Have you ever felt that absolute crushing pain of watching your hard-earned money just vanish, all because you were basically guessing where the price was going to go? Yeah, it's incredibly frustrating, right? Well, today, we are putting an end to that. Think of this explainer as your direct roadmap. We're going to take you from being a trader who just relies on hope to a precision trader who knows exactly what to look for. So let's just dive right in. Ask yourself, what actually drives the price? We've really got to break the habit of looking at charts like they're just chaotic lines or magical patterns. The truth is, honestly, much simpler. Think of the market as this massive global tug-of-war between two really aggressive groups, the buyers and the sellers. That's it. Price moves purely based on the balance or the imbalance of power between those two sides. To get you trading like a sniper, here is our roadmap for today. First, we'll cover understanding supply and demand. Then, finding strong zones. Next, how to draw those zones accurately. And finally, the liquidity sweep pattern. Let's get to it. Part 1. Understanding supply and demand. Let's break down these two core concepts. A demand zone, it's basically a floor. It's where buyers previously stepped into the market super aggressively and forced the price higher, so it acts as potential support. On the flip side, a supply zone is like a ceiling. This is where sellers took total control, forced everyone to accept lower prices, and pushed the market down. It acts as resistance. But here's the absolutely crucial secret. Markets actually remember these zones. When the price eventually revisits them, those exact same aggressive players will often step right back in. Now you might be wondering, how do we actually know they were aggressive? Well, we look at the volume footprint. These aren't just random arbitrary shapes on your screen. They are the literal footprints of big money. This footprint shows us exactly how much buying and selling happened at a very specific price level inside a single candle. If buyers are just totally overpowering the sellers, we're going to see massive volume on the buying side. It is the undeniable internal record of that tug-of-war we talked about. Moving right along to part 2, finding strong zones. So how do we filter out all that slow, random, sideways market noise? We use what we call the Rule of 3 checklist. Step 1. You want to look for a really impulsive price move that shows a clear, massive imbalance between buyers and sellers. Step 2. For a valid demand zone, we want to see 3 consecutive green momentum candles. Boom, boom, boom. Step 3. For a supply zone, look for 3 consecutive red candles with nice, large bodies. We are strictly hunting for areas where traders showed real, undeniable, aggressive interest, nothing less. Okay, part 3. Drawing zones accurately. Knowing what a zone is isn't quite enough, right? If you want to trade with absolute precision, here is your golden rule. Always, always focus on the exact area where the impulsive move began. Whether you're marking the last red candle right before a massive bullish run, or the very first green candle that triggered a huge downward avalanche, your focus literally has to be on that origin point. That's the exact split second the balance of power flipped. A totally critical tool for finding this exact origin point is the wick, or as it's known in Vietnamese, bung nhan or rao nen. This wick is an incredible psychological marker. Think of it like touching a really hot stove and instantly pulling your hand away. It's the literal moment the market just screamed no to a specific price level. The momentum move doesn't always start at the thick body of the candle. Actually, it often starts right at the very tip of that rejected wick. Okay, so once you've drawn these zones, how do you actually survive the trade? First off, to avoid missing out when the market just barely taps your zone, place your entry as spread size just above the zone. Second, to survive those extremely frustrating stop-loss hunts, you know the ones, give your stop a little bit more breathing room on the smaller zones. And for the really large zones, just enter near the middle and tuck your stop loss safely below the entire area to properly shield your capital. It's all about playing it smart. Finally, we arrive at part 4, the liquidity sweep pattern. This right here is the secret weapon. This pattern turns institutional manipulation into your biggest advantage. It uses a really brilliant dual time frame strategy. Step 1. Jump on a higher time frame, like the 4-hour, to find the main trend in your major zones. Step 2. Be extremely patient and wait for the price to fully enter that zone. Step 3. Zoom into a lower time frame, like the 15-minute, to pinpoint your exact entry trigger. And please listen carefully. Never enter early. The market constantly hunts for early entries and uses them as liquidity fuel for the real move. And that brings us perfectly to the liquidity sweep itself. This happens when the price breaks above a previous high or below a previous low, but then it immediately rejects and snaps right back inside the previous range. It is the ultimate proof that one side completely failed to hold their ground, and momentum is rapidly reversing. So a bearish sweep happens when the price breaks above a high, traps all those early buyers, grabs their liquidity, and then immediately aggressively pushes back down. That is a beautiful signal for a short trade. Conversely, a bullish sweep breaks below a previous low, traps the sellers, and violently pushes back up for a long trade. And let me tell you, these patterns are just incredibly powerful when they happen perfectly inside those higher time frame zones we drew earlier. Here are your precise, sniper-like instructions for execution. Draw a literal line on your chart right from the tip of that wick. You execute your entry the exact moment the price closes back inside the range. Don't guess, don't try to anticipate it. Just wait for that closing candle to formally prove the sweep is confirmed and the trap is set. Let's quickly lock in our golden rules to ground everything we've talked about today. 1. Always trade with the trend. Never fight the overall momentum. 2. Patiently wait for the price to actually hit your zone. 3. Look for that liquidity sweep on the lower time frame to confirm your entry. And 4. Always use strict risk management. This isn't gambling, folks. This is your safe, highly repeatable framework. So I'm going to leave you with this one critical question. Are you going to keep guessing and hoping, or are you ready to start trading by following the precise footprints of big money? The tools are literally right here in your hands now. Go open a chart, start hunting for these exact setups, and completely transform the way you trade. You've got this.